So onto a little bit of the educational side, and we won't spend too much time talking on this, but I thought it would be quite good to talk to you a little bit about the due diligence that our underlying investments or portfolio managers do in terms of looking at the loans that they are brought. So they typically will run origination teams, which will bring them loans to have a look at. And it's quite important to understand their due diligence and how they go about assessing these loans, whether they should be funding them or not. So the objective of a due diligence from their perspective is to evaluate the creditworthiness of a borrower, and that will ensure that the private lending deals are structured with minimal risk and optimal returns, hopefully. Due diligence in private lending is the investigative process used by lenders to assess the borrower's financial condition, their operational capability, the industry environment, and the creditworthiness of the borrower before they will be extended a loan. This typically will include reviewing all financial docs, legal docs, and the operational aspects of a borrower's business. The due diligence process typically focuses on five key areas or five critical categories. The first of this being financial due diligence, which is the analysis of the borrower's historical and projected financial performance. Next, we tend to look at business and operational factors in the due diligence process. So this is looking at their business model, their operational structure, what their positioning is in the industry, and assessing their strength there. Furthermore, we'll move towards the legal and regulatory side. And in this set of reviews, we try to ensure that the borrower complies with relevant laws and regulations. Always important that they're not breaking the law. From an asset perspective or collateral perspective, we want to sit down and look at the collateral that we're having as pledges, or that we're being able to have a pledge over. From a security perspective, we want to understand their quality, the value, and we want to know where the ownership of that lies. And then finally, the credit history and the reputation of the borrower. Clearly, we want to know that historically they've been financially reliable and they have a strong reputation. The tools and techniques that we would typically use in this process, or our managers would typically use in this process, there's five key areas there as well. First of which is financial modeling. So getting in there and having a look at their financials, we would go out, or managers would go out and create a multi-year forecast and try and understand what the business's ability to generate cash will be. And that will obviously tell you whether they can service the loans and repay the capital at the end of the period. You'll do discounted cash flows and scenario analysis around that. Benchmarking, we're typically going to compare the borrowers to their peers in the industry and understand if they're at the top end or bottom end of that scale. We'll always get out there and conduct site visits. It's really important to physically inspect the business, the location, and the assets that you're going to get as security. From a document verification perspective, it's always important, we think, not necessarily to take the borrower's word for what they're saying to you. So if they're giving you documentation, we'll typically have, or our managers will typically have, third-party auditors in there, or third-party legal advisors to check and see that documentation is valid. And then obviously background checks are always important. Some of the red flags that we've seen across time, weak financial statements, so negative cash flows and high debt levels typically are a red flag for us. That's it's always going to be a good indicator that someone's going to struggle to repay loans. If the collateral is questionable, I think to us that's probably one of the key areas. Overstated asset values or even disputed ownership is one of the spaces where you can get really hurt here. You need to be making sure that your valuations on assets, specifically property, tend to be very current. Certainly, if you're in an environment where property values are declining, you want to make sure that you've got a really current and spot-on valuation on those assets. Legal issues, so history of litigation, tax arrears or violations, and poor credit history are obviously key flags as well. And then finally, if you're seeing turnover within management or the business model tends to be weak, it's something that will turn us away from a loan.